Well, friends, the Fed did pretty much exactly what we thought they would. They didn't raise rates. They talked about inflation being persistent. They said future rate hikes would be data dependent. But the market didn't like one thing that they mentioned, and rates touched the highs yesterday that I called a few weeks ago. And I said I didn't think that they would go over that mark again. Well, they hit it today. We're a little bit better, about 1/8 of a point better today. But the thing that they said, they have this thing called the dot plot map. And they were already saying that they're going to cut rates by the end of next year. Well, they revised those rate cut revisions down a little bit. Now, this dot plot map, it's like, basically, if you and I shot some darts at a board and said, hey, here's what we're going to do with interest rates, that's about what it means, because the consistency at which they follow their planning is, well, incredibly inconsistent, because there's so many factors that make up the market conditions. And so they're like, hey, well, maybe we think this is what we're going to do, but then the data says something and they do something else. So it was actually really a surprise to me that the market reacted as negatively and pushed rates back to the highs that we've seen in rates for the last 23 years. Again, it just doesn't change my forecast. Rates are going to come down. If you're buying now, you're going to get rewarded in the future when you get to refinance. But right now, we still have just this little bit of inflation headwinds. And I do appreciate the Fed being slightly hawkish and making sure that we don't have some severe stagflation, because that would be absolute worst thing for our economy. But I also don't agree how the traders reacted so negatively to the reactions. I'll keep you posted. I'm Zalmanoff. You know that. Peace out.